Welcome to the February 2020 edition of the Srini Nonprofit Connection. We're very pleased to have with us today Peter Klein, Chief Investment Officer and co-founder of Align Wealth Management, with offices in Melville, New York City, and Florida. Welcome, Peter.
Welcome. Thank you. Thanks very much, Ken. I really appreciate being here.
So Align is a new name.
It is. It is.
In the past, it's been Klein Wealth Management. Now it's Align. You want to
spend
2 seconds talking about why the change?
I certainly do, and thank you. Thank you again for having me here. Align Wealth Management is the new firm's name. It's still Hightower. Hightower is still powering our firm, but Align Wealth Management is the coming together of two practices, two firms, Klein Wealth Management and MK Wealth Management, headed by Mark Kravitz, a friend who I've known for 30 plus years. Mark's focus is in exit planning, and my focus, as you know, is in philanthropic planning and charitable planning. Together, our team, we are so blessed to have a great team of folks with us, are focused on helping individuals, endowments, foundations, business owners in reaching their financial objectives.
Yeah, so that's obviously why we have you in the room, because when it comes to investments and it comes to investments for the nonprofit sector and all the different factors that come into play there, who better to ask than you, the expert?
Well, I appreciate being here, and I appreciate helping out.
So when you think about investments, and you think about investment strategies for nonprofit organizations, there are a whole bunch of different types of ways that nonprofit organizations have funds. I mean, they have their operating funds that are sitting in their bank accounts. They have pension funds and things like that. They have endowments and excess resources. So when you kind of consider investments, are you looking at things from an overall picture perspective? Are you looking at pockets? How do you kind of view the whole?
Well, first off, the first thing we have to talk about is the fact that when we're dealing with these types of funds, when we're dealing with board-directed funds, we'll call it that way, where there's a board, it's not like your account or my account, right? It's a board's responsibility to run this capital. The first thing we have to always talk about is fiduciary responsibility, right? Okay. I mean, that's number one, because this is not their money. This is not something they could take a flyer on. This is not something they could invest haphazardly. They have to do it in a very fiduciary-centric way. So that's the top line. Then from there, we typically suggest an investment policy statement, which is required in many cases for these types of funds. Now, if it's an operating portfolio, an operating account, frankly, that's mostly cash, right? So it's not much more you can get these days in the fixed income markets more than cash returns. So if this is capital that they're going to be spending on a monthly, weekly, quarterly basis, our typical thought is to keep that as money market types of balances.
But even on the money market balances, there are some money markets that pay more than others. I mean, I've seen money markets that are paying like 0.3% and other ones that are paying closer to 2%.
You want the latter.
Yeah.
I mean, obviously, and we do work with our boards to help them find those. I mean, again, that owes back to the fiduciary nature of that board to make sure they get the very best return for their capital. But when we're talking about investments, and we're speaking about foundation endowments or a nonprofit endowment portfolios or board funds, as sometimes there are certain funds that are segmented for the board to use discretionary basis.
So like board designated funds.
Yeah.
Okay.
There again, that's going to be more invested, right? Those kind of portfolios are not just going to be sitting in, operating cash, money markets. They're going to be invested. And that's where, it's critical to look at the investment policy statement to say essentially to the board, what are we looking to accomplish with these funds? What's the tolerance for risk? What's the liquidity requirements? What's the time horizon? And then, there's also the important, it's often missed by a lot of folks, is the restrictive nature, unique circumstances, right? So I sit in front of these boards all the time, and it gets into these questions like, well, what don't you want to invest in? What should we be mindful of from a restrictive nature?
So you're talking about maybe a company that is outside the realm of what the nonprofit may do or what the nonprofit may believe in.
Bingo. mission-driven investing.
Mission-driven investing. Okay.
So critical, because how bad would it be if they look at this portfolio and they're an organization that's, pro-environmental and very much that's their focus, nonprofit-wise, and their portfolio's full of fossil fuels.
Yeah,
That's just it's not gonna look good,
right?
And it's not congruent to their beliefs. So a very important first step is to really get a sense on who the organization is, what they're all about, and how they want to have their portfolio perceived with respect to mission. And then from there, there's another segment that could talk about impact, right? Okay, well, not only do we want to invest in a environmentally proactive way, ergo not investing in fossil fuel companies. In fact, we want to go further and we want to invest in companies that are moving the needle forward, that in that area.
Sustainability,
Correct.
small footprint, all those types of things.
That's right. And and many of them say, we could help seed these companies. That gets a little bit speculative, so you got to be careful how much you put into that. But oftentimes, I have foundation portfolio clients that use their portfolio in many cases to help drive their mission, which is really interesting. So it's not just now the grants that they're making to move their mission forward, it's also their balance sheet. They say it's a 95% versus the 5%, right?
So that brings up a good point, because we're talking about nonprofit organizations, and nonprofit organizations, it's a broad base of, it could be anything.
Sure.
And in here we have public charities and we have private foundations. And I think the way you look at a private foundation is going to be very, very different from the way you look at a public charity.
Of course.
You want to kind of discuss that a little bit?
Yeah. So in a private foundation, you have oftentimes a smaller board. Many times the board is made up of the founder's family, or the matriarch or patriarch of this family had a monetization event with their business, whatever, and they fund this family portfolio. And it may be a generation later when the grandchildren are now running that portfolio. It's a very different animal than, say, a public charity.
So from an investment perspective, should they be focusing their investments differently, or does it not really matter whether you're a public charity or private foundation in terms of how you focus on investments?
Well, I think the focus has to be, number one, again, always being in a fiduciary-centric mindset. And then secondly, you look at that investment policy statement. You got to have that. That's critical. But from a perspective of investing, I don't necessarily think this will be, in other words, I'm not suggesting that the private foundation portfolio can take more risk on than the public charity. Yeah, maybe a little bit, because it's sort of monies that they're, if it's not sunsetting anytime future, the board can decide to reduce their grant making to that 5% minimum level versus maybe an 8% if they had portfolio if their portfolio was not performing as well as they'd liked. We want to give it more time, whereas a public charity may not have that same ability. So I would say it's a heightened responsibility on the public charity side.
So when we look at this, and I think, you talk about fiduciary, and, there's also that whole concept of prudency.
Oh, yeah.
And what's prudent within the nonprofit sector, and, what should an organization invest in? And one of the things that I find that nonprofits tend to be extremely conservative with their investments. They look at, hey, we've got 365 days of cash sitting on hand, but we're investing that in mutual funds, not mutual funds, some money market funds. Is that really prudent? Is it not prudent? I mean, what actually is the definition, if you don't mind me asking, of prudent when it comes to all this?
Well, in many cases, there used to be an old definition called the prudent man rule, which is sort of like, what would a prudent man do in this kind of, in this kind of circumstance? They've recently changed that. And I think UpMIFA, we'll get into that, speaks to this a little bit. But essentially, you need to take a look at many, 8 different factors. But in many cases, you need to understand the portfolio in its entirety. It's not just one position. Whereas in the past, you wouldn't be able to buy, say, XYZ company stock for whatever reason. But now it could be part of an overall portfolio if it's diversified. So I think diversification has really become a much bigger aspect to portfolio management in both, the foundation side and the public charity side.
One of the things you mentioned in that answer was you talked about UPMIFA. And I know New York State has New York State's version of that, NIPMIFA. For the people who maybe don't know what NIPMIFA is, do you mind just explaining? And NIPMIFA, as you know, is the New York Prudent Management of Institutional Funds Act. But
right,
what does that actually govern and talk about?
Well, essentially, this is an act of law that says, hey, if you're a institutional fund, in nonprofit fund or a pension. Funds have ERISA, so it's a different category. But essentially, they're giving you a guideline on what best practices, if you will, you should be abiding by with respect to investing in these portfolios. And there's about 8 different pieces of it. I mean, again, we mentioned the investment policy statement, the importance of making sure that there's a preservation of the endowment fund. And what's the purpose of that endowment fund? You also have to know about the general economic conditions. And that brings up another point. When we look at the board members or of a committee, for a financial committee, let's make sure those board members understand finance. Oftentimes I find like the folks that raise their hand to join the nonprofits and the nonprofits finance committee are just folks that sort of have a interest in finance, and they raise their hand. They think it's going to be interesting, but that's not enough. You really got to understand what's going on, because one of the rules in NIPMIFA is you have to understand general economic conditions. So you say interest rates are very low right now, almost as low as money market rates. Then what value do we really get to going into fixed income? We're just better off staying potentially in, no risk cash.
Yeah, got it.
Right. Why go out? Why take duration risk out and go out in fixed income especially for operating funds? So understanding these issues, understanding what's happening in the global financial markets is an important requirement for I think board members on finance committees.
And just to clarify, you're not saying that we shouldn't diversify the portfolio. You're just saying that in the diversification of the portfolio, you have to consider risk. And in that diversification and consideration of risk, in today's marketplace, a fixed income fund may not be as worthwhile as lowering the risk in that area through holding it in cash.
And not only that, Ken, but how about the fact that there is risk in fixed income funds? Yeah. Especially when you look at negative interest rates around the world, near inversion of our yield curve, I don't think you're getting paid for the risk. And I think that I've counseled many of our clients to say, listen, fixed income's lovely. Under normal conditions, this is not normal. Negative interest rates around the world is not normal. So when things are not normal and things are confused and rates are very low, what return is it worth the risk?
Right.
And there is risk in fixed income. One day we're going to get inflation. One day we're going to have increasing interest rates. They tried that about a year and a half ago, and they stopped it immediately because the market couldn't handle it. So I worry about that. I mean, in the end of the day, we have to always look at to do no harm. That's really what it comes down to.
And we'll come back to NIPMIFA and how NIPMIFA impacts endowments and things like that in a few minutes.
Sure.
I want to focus and stay on this whole thing about risk and investments. And, I think one of the things, and actually touching on what I talked about before in terms of prudence, because one of the things that I, as I said before, is I find that organizations tend to be very conservative. Boards of directors and finance committees are looking at things as, this is not my money, I need to protect it, and the most important thing is preservation of the asset.
Mm-hmm.
But as you said, and what I heard you say, in today's marketplace, with fixed income not really being the greatest thing in the world because of the negative interest rates and everything else, putting money in, if I have excess funds that are earmarked for long-term purposes, or I'm not going to need them for long-term reasons, putting them in a fixed investment may not be the most prudent thing to do with these funds. And organizations really do need to start thinking about what other investment options exist.
And what are they, right? So they're exactly right. So if fixed income is becoming somewhat morphed as an asset class, largely due to the fact that they're risk return dynamics are upside down. In other words, you got a fair amount of risk, ergo rates go up, prices go down, then the return you're getting, which is infinitesimal. Maybe that is why I've been saying less fixed income, more perhaps cash as an alternative to fixed income.
But they also still need to have that equity side of it too.
Of course. You got to grow. And maybe also the alternative sleeve, which gets forgotten about a lot. Alternative. So when I say take from fixed income, put a little bit more into cash, similar returns, potentially, no risk in cash, by the way. And then, but that's not enough. I mean, it's a low returning asset. By putting it into alternative, so you have market neutral funds, you have commodity funds, you've got, and again, diversification, right, across the board. So there are other gold, silver.
I was going to say, is that where precious metals and REITs come into effect too?
Yes.
So real estate investment trusts.
Bravo.
Okay.
Right. And then of course you have your equity sleeve. That's your big piece of typically the largest piece of the portfolio. Again, hyper diversified. Both by asset class as well as by individual security. So not only do we want to have large cap, small cap, mid cap, international, emerging, domestic, but we also want to have, each piece of each sleeve to be relatively diverse. You don't want to have an overweighting in one particular asset or asset class.
One of the other things that we often see in the nonprofit sector is that there's someone on the board or someone on the board's brother or sister or nephew or whatever who does investments also. Now, at the beginning of this, you said that you specialize in working with philanthropic organizations. So what's the benefit of working with someone like you who specializes in the nonprofit and philanthropic organizations versus working with a normal broker?
Yeah, well, as an advisor, as a fiduciary, as a registered investment advisor, independent investment advisor, our clients always come first. That's the bottom line. It's fiduciary centric. I can't say that for others. Everyone has their different protocols. At our firm, at Align, at Hightower, clients come first, they come second, and they come third. Always, period. So that's the first thing. Always putting we don't manufacture product. We don't have funds to distribute. We don't do that. We do one thing and one thing only. We understand our client, be it a foundation, an endowment, a nonprofit, a business owner, or an individual, really, really well. We get into their skin, understand what makes them tick. And then from there, we develop this investment policy statement, which codifies these issues. And then we go out to Wall Street, to the capital markets, to optimize a portfolio to meet their goals. Others can do the same. I would say be careful when you're giving the account to someone who's a relative. First off, I would say that is probably questionable ethically from a perspective of
conflict of interest.
Yeah. And then secondly, is that person the right person? I mean, I've done this for 30 years. I've focused on the philanthropic sector for about 12. I've written books about it. I'm a certified, chartered advisor in philanthropy. So I put the effort in, and I love the sector, as I know you do. It's an important sector, but it has to be done right. And remember, folks, this is not your money. It's not my money. This is the society's money. So we have a heightened responsibility to make sure it's invested in a correct manner.
Yeah, and I think also, understanding, in addition to the investment side of things, but understanding the rules and laws and regulations within New York State that govern this area, I think that helps too.
Yeah. I want to just clue in on one thing you said earlier too, is, when board members are typically conservative, and think about it for a second, they have no reason not to be. They don't want to go out on a limb. And in fact, what they're doing essentially is not exercising their fiduciary responsibility. They're basically taking a knee, really. I mean, they're just saying, okay, why don't we just go and put it into the most conservative thing? Or what they've done most recently, and this is an interesting discussion, is to go passive, to put capital into index funds, and to say to themselves, okay, money's in index funds, we're set. Now the question, it's still stocks, it's still bonds, it still has risk, even though it's in an index fund. So this notion of going automatic, this notion of saying, oh, I'm covered because I'm in index funds or because I've got all my money in cash, is not exercising fiduciary responsibility.
Yeah, you brought up several topics. I'm going to try
Dig
to
in.
remember all of these
Okay.
as I ask the questions, and I'm sure I'm going to forget them. But so the first thing is, I know the board has an active responsibility in terms of looking at their portfolio. So on an annual basis, the board of directors has to, and you talked about in the MIFA, you have those 8 characteristics that investment needs to be there from an investment perspective. I know the board has an active responsibility to view those on an annual basis and document within their minutes that this is actually happening. Are you seeing that happen? Because I'm not seeing that happen.
I'm not, and I think there's a lot of education that needs to be given. I think that that's an opportunity. You and I should go out on the road and give talk. I mean, there's a lot of nonprofits that are not getting this, and to their detriment and to their risk, they need to understand the rules of the road. Now, they may be insulated, quote unquote, because they've got a very conservative portfolio and they feel like, okay, but that's not. Yeah,
but I think even with a conservative portfolio, even if they have all the money in cash, I still think they need to go through the process saying, we reviewed our portfolio and cash is the right place to be based upon these factors.
That's right. And here's why. Right.
Yeah.
And this is what we heard. This is what we learned. We had a conversation. Document.
Yeah.
You can't over document. You can't over minute. You have to put the information down, and I think that's so important.
The other thing you brought up that kind of triggered something in my mind is you said, that a lot of times, or what you're starting to see now, is that portfolios are being put on autopilot. And, when I've always looked at a portfolio, I guess old school, I always thought of, red, yellow, green, where you look at every investment on a regular basis and rate the investment. Is it green? Keep it. Yellow? Watch it. Red? Get rid of it.
Right.
And maybe you can talk a little bit about what that investment review should look like and how often it should be done.
It should be done quarterly. It should be done with the board or the finance committee involved. We do a complete download of the entire portfolio for our clients, and we try to show them what we call attribution analysis. So we want to show them where the return is coming from. Is it coming from just one position that happened to do well and everything else is not doing so great? Ergo, we got lucky? Or are we seeing our sort of thesis play out? In other words, if we said emerging markets are cheap and opportunistic at these levels, so we're going to overweight slightly that sector, and then we have a review 6 months later, and we show them, hey, you see that particular sector has been where much of the gains have come from, much of the appreciation has come from in your portfolio. Or not, but we want to be able to sort of link it from what our thesis is and was to what the performance is at the current juncture, and then make sure that board and that finance committee, because oftentimes it's finance committee, then they tell the board, make sure they understand what's going on in that portfolio. Make sure they understand what our allocation is, what our thesis is, what do we expect, what's our strategy. They need to know that. We're going to tell them. And we're going to make sure they understand it, and then hopefully they then communicate it, and it's in the minutes too. It should be.
The other part about that autopilot that I wanted to bring up is, and the fact that you're reviewing on a quarterly basis. I mean, I think one of the other important pieces here is, as you said, you've got fixed income that's not doing too well. You got the stock market right now that's flying. So if you're in a situation where you made an initial thesis or discussion that you're going to have 30% fixed, 70% market, stock and equity, the market flies, the fixed income stays where it is.
You got a balancing issue.
Now you're at 85-15. So I think part of that also is, did your thesis change? If it's still the same, then you need to rebalance.
And if you don't rebalance, shame on you, or shame on the board.
And then are you meeting your fiduciary responsibility?
You're not, because you wake up one day and you realize, oh my God, I got 90% of my assets in equities. I thought I was a 50% person. Yeah. Well, you were. We didn't trim it back, and that's there's no excuse for that. No, we have to be able to do that, and that's what the importance of the investment policy statement is. It holds us to task. Yeah. It says, hey, this is not a gambling. This is not your own personal money. This is society's money and nonprofits, capital, what have you. We have to be mindful of those risks.
Yeah, and then again, I think that's why also you need to have that regular communication and that regular
the cadence.
interaction with the investment advisor.
And lest we forget, it's also no taxes. So there's no, selling, I know when we would personally in our own portfolios, yes, taxes involved. Not with nonprofits. So there's no taxes. And, you could speak to the new excise tax that just came out this year for foundations. They've sort of made it easier, I guess. Yep. But besides that small excise tax, there are no taxes and there's no cost. Usually, in our firm, we manage capital on a fee-based level, so there are no additional commission costs. And I would suspect that that's normal. So by rebalancing, you're not really causing any friction in the portfolio.
You're actually creating a better solution at the end of the day.
Correct.
Now, you've talked about the investment policy at least 26 times already. I've been counting. So from an investment perspective, when should an organization have an investment policy? I mean, is it something that every organization should have? Is it something that an organization should have once they have a certain level of investments?
I say every organization in our practice or our clients have investment policy statements.
And what exactly goes into an investment policy?
Right. So there's a number of different pieces of it. We like to use a very down and dirty, so to speak, bullet pointed version. We don't want a sort of boilerplated, multi-page book that no one reads, right? We want something very codified, very simple. And what we want to do there is to make sure that the client, the foundation or the endowment or the nonprofit organization knows that we've listened to them. So the first thing is the objectives. Capital appreciation is typically what they say, but some of them say current income as well, right?
And some of them also say
combination,
safety of corpus.
That's right, and that's an important piece of the puzzle. And that comes into play when you're dealing with UPMIFA and NIPMIFA as well. But yeah, so it's an objective. What are the objectives of this fund? And sometimes they have multiple funds. Like this fund here might be our long-term capital growth fund, and this one here might be more of a near-term income fund. So we sometimes have that duality of mission. Then the second thing is risk tolerance.
Sorry, I'm sorry, I'm going to interrupt.
Yeah.
So it's looking at time horizon of needs.
Yeah.
So when do I need the funds? And I'm going to try to
Correct.
match my investment to the
Bingo.
needs of the
right.
funds. Yeah.
And those are the constraints, right? So it's time horizon, it's risk tolerance. We try to do a deep dive, and we've got a really interesting software program called Riskalyze that allows us to stress test portfolios and to also query our client, the board, or the finance committee. We give them a questionnaire, very simple, to get an idea from them what does risk look like in their minds. Because oftentimes clients say, oh yeah, I'm a very low risk, and then they answer the questionnaire, you find out they're not so low risk, right?
Yeah, low risk means I don't invest in emerging markets, but I invest in every stock you can put in front of me. Yeah.
Right. So you got to sort of dig that in a little bit and try to figure out what their real risk tolerance is. But other constraints, you're right. It's time horizon. It's taxes, which are minimized. Any kind of legal issues that might be. Sometimes these nonprofits have certain legal aspects to them, and we need to be mindful of any kind of restrictions that they may have. And then we talked about the unique circumstances that many nonprofits have with respect to their portfolio and their mission and the alignment of both.
Yeah, I think it also comes down to what other resources are available, how quickly the receivables are going to come in and get, because I mean, if I've got a regular flow of receivables, I don't necessarily need the cash to hold as many days of cash.
Right.
If I've got one big fundraising event a year, and I'm going to need that cash flow to last me the entire year, I'm not going to be sitting here investing it.
That's right. And it's important that we understand that so that we could allow, and we also need to know the spending policy with respect to the segmented funds. So let's say, this particular portfolio is for long-term capital appreciation, but on occasion they may say we do dip, quote unquote, into the fund to help us with our operations. Well, let me see what that dip looks like. What's the amount? What's the cadence? What's the likelihood of it? And let's make sure we have a certain amount of cash available in the portfolio to handle that. Because the last thing you want to do is have the board say, I need that that chunk of capital this month, and then the portfolio's down because the market's down, and you didn't reserve it, you didn't have it on the side. It could be you're forced to sell at the wrong time.
Right. So what investments should be covered under the investment policy? Is that all investments that include pension and cash and everything else?
Yeah, separate investment policy statements, I would suspect, from a pension fund, because again, you have ERISA in there, so it's a little bit of a different animal. But yes, I would say every investor, every investment portfolio should have a policy statement, even if it's simply one that allows the investors, the actual client, to be aware, to make sure that their financial advisor understands. And that's really what the crux of the issue is. If you have confidence that your investment advisor understands you, understands your needs, your objectives, what your risk tolerances, your cash flow needs, and of course your mission,
Right.
and then you're in the right spot, 90% there.
All right, I'm going to switch gears a little bit if you don't mind.
Sure.
We've talked about NITMIFA from an investment perspective, but NITMIFA just doesn't cover investments. NITMIFA, the other big piece of it and a main component of NITMIFA has to do with endowments.
All right.
And I find that endowments and investments go hand in hand, because endowments, you're assuming those are funds that are being held for a specific purpose. There's usually a long-term hold, and there's usually a need to generate income off that. And as part of a lot of investment policies, those policies also should have a spending policy component of it too, especially when it comes to endowments. Do you want to talk maybe a little bit about spending policy, maybe a little bit about how NITMIFA kind of impacts the whole endowment aspect of things?
Sure. Yeah. I mean, spending policies is a critical part of the discussion that we have with the board, because it's important for us as investors of the foundation's assets to understand the cadence to which they need that capital outflow. Right. So, and there are different policies. There are different spending policies. There are some folks that use a straight, percentage of current assets. So they'll say, okay, December, let's say the year end happened to be June 30th. And they'll say, okay, June 30th, we have, $10 million in our investment portfolio. We're going to spend 5% over the course of the next 12 months. Maybe it's every quarter distribution. And that's one kind of example of a spending policy.
So, and these spending policies you're referring to right now have to do with either a private foundation, which has the need to spend the assets within there, or endowment, because an operating nonprofit is going to have the operating expenses that they're going to have to lay out.
Right.
But so this would be for the endowment component of it. Just want to clarify.
Thank you. And for endowments, sometimes so foundations. So for the folks out in the audience, foundations have a requirement.
Yes.
To have a 5% spend policy, right?
At least 5%.
Right.
Yes.
At least 5%. They can go more,
that's
carry forward.
Yes.
Yep. By the way, just as an aside, many of the folks that might be listening may be wondering what about donor advised funds, and those do not have a defined spending requirement.
That's right. But some of the donor advised funds, the larger donor advised funds, even though they don't have a required spending policy, what they do require is there to be some level of transaction that occurs within the donor advised fund every so many years.
Because why? Because they have to. Because think about
somebody
the guy,
dies,
right, and his money's sitting in there. The investor's gotten a tax deduction for it, and now it's not gone to the end need. So there has been some legislation out there now talking about a 5 year or so. But anyway, I digress. So spending policy. Now, there are endowments that we talk with, and we have clients who, rather than just do a straight 5%, what they'll do is an inflation hedged 5%. So they'll say, we're going to give 5% away plus inflation, because they know that their end user, their nonprofits or their organization that the endowment's used for, has increasing costs themselves. Right. So 5% today is not the same thing as 5%. 5 years from now. So they want to sort of include that sort of inflation rider to it as well.
So let's kind of jump back a half a step. So when we look at endowments, okay, well, obviously an endowment are funds that were put aside by a donor for a long-term purpose to be held in perpetuity or quasi-perpetuity by an organization. Typically, the income stream that comes off that is either used for operations or used for a specific purpose of the organization. So that's kind of the definition of an endowment. And when we have these endowments, an endowment is controlled or put out there by a donor, because the only person who can create an endowment, a board can create a quasi-endowment, but the only one who can create a true endowment is a donor.
Yeah, donor, right.
So when we look at donors and we look at endowments, we talk about them with respect to NITMIFA. Do you want to maybe spend 2 seconds talking about what does NITMIFA say with respect to an endowment, and when does NITMIFA even come into play?
Well, right. Well, it really, a lot of this has to do with this notion of tapping into the corpus, right? Spending down the corpus, evading the corpus, right? And the idea is that if you're a donor and you're giving a certain amount of capital, your capital, to an endowment, you may have restrictions in place. Those restrictions might be to whom those funds are directed to, the projects that you're, or you may have also some restriction about invading of the principal. And and the MIFA speaks to that. And there's actual language that you have to abide by when that donor is solicited, before they even put the capital into the nonprofit or before they put the capital into the endowment. There has to be an agreement there. They have to understand there's some capital. I think you have some of the language in front of you that has that talks about that.
Yeah. So again, I think at the end of the day, I mean, I think it comes down to, and what nonprofits have to think about is donor intent.
Yeah.
So what is the donor intent? And if the donor intent is clear within the giving document, then you have to follow the donor intent.
Sure.
And if the donor says that the corpus cannot be invaded, then you can't invade the corpus. I think what we're seeing is more and more nonprofit organizations are trying to move away from a non-invasion of corpus and allowing, which NITMIFA does allow, the invasion of corpus, because I think what most organizations find is that it really is the donor's intent, or should be the donor's intent, to give money to an organization where that money can actually make a difference and have an impact.
Of course.
And if I say you can't invade the corpus and the market's down, I can't invade the corpus and nothing gets done.
It's the old way of thinking. It's the sort of the bond way of thinking, where people put money into bonds and it's all they had, so the corpus very rarely went down. But that was in the days of when you got 7 or 8% on bonds. You're not getting that today. So you do have an increased volatility issue. And you're right. If that were the case, then the net nonprofit's not getting that important capital, which they then need. And frankly, they probably need more because the market's down and the economy might be off. Their fundraising might be off.
Yeah, and one of the things that we see a lot, and think about endowments. I mean, they're very big in schools, very big in hospitals, very big in, if you're using that endowment for a scholarship or for charity care or something like that, those things continue to happen year after year after year.
Mm-hmm.
I mean, scholarships don't end because the market's down,
and they go up in price. So the cost of those programs go up too. So not only do they need the money, they need probably a little bit more. So
so that's where I think NITMIFA plays an important role in terms of the endowment side, is because NITMIFA does allow donors the board to make a decision to invade the corpus.
Unless correct me if I'm wrong, unless the donor says no.
That's right. So donor intent comes first, then NITMIFA.
Right.
If the donor intent is silent, then NITMIFA comes into play.
Right. And if you think about it, the donor is more likely to say, yeah, my goal is to help these kids in a scholarship. If the portfolio is down temporarily, sure, you should look to make. I don't want you to stop giving because of that. So I would tend to think most donors get that.
Yeah, and this also goes back to what you said in terms of the wording within NITMIFA. So you're in a situation again within NITMIFA where NITMIFA basically says that if you're looking to solicit funds from a donor and you already have an endowment, so you're looking for donations into the endowment, or you're creating an endowment looking for donations into the endowment, unless the donor says otherwise, your goal of that endowment is to spend or be able to invade the corpus of that endowment, unless the donor says otherwise, as I said, then you need to, as you said, have specific wording in there, which basically says that we reserve the right to invade the corpus. And there's specific wording within NITMIFA that, people should go into NITMIFA and look, and I'm sure if anybody has questions, they can reach out to you or me, and we're more than happy to point them to where in NITMIFA it says this. But
fundraising executives and those in that field should be well aware of that. And I think
you say that, but we still see, we talk to boards all the time, and
no one knows this stuff.
We see that, and NITMIFA. I mean, it's not a new law. It's been around since 2010.
I know.
October of 2010.
It's unbelievable to us. I mean, to you and me together, in this field, how blinded some folks have been. It's time to wake up.
So again, like we talked about it from an investment side. So NMIFA has certain rules and requirements that an organization needs to go through and a board of directors needs to look at when it comes to investments. I believe that there's similar process that boards have to go through with respect to endowments before they're able to pull those funds out.
Mm-hmm.
So
you have to look at general economic conditions. You have to look at the portfolio diversification. You want to make sure you're, is the actual need of that particular outflow required, so there's a lot of different moving parts there.
Are the resources available?
Correct. Can you go elsewhere for it? Can you hold off for a 6-month period because things are not looking so good right now? But yeah, it's called mindfulness. I mean, if you think about it, it's really just board members need to get educated about their responsibilities. This is not the type of thing where you just raise your hand and say, okay, I'm on a board. This is great. You got to know what you're getting into. And you got to know there's requirements and there's a lot of work to be done. And I know you know this and I know it, but a lot of folks don't. And I just, again, we hope there's never a blow up or never an issue. But when it is, that the board is certainly required to make sure they have that responsibility.
And the thing also to remember is NMIFA is a law.
Yeah.
It's not,
it's not guideline.
It's not an accounting regulation or something like that. Right. A lot of people say, well, no, that's it's not an accounting regulation.
Yeah.
I didn't just make this up.
It's not best practices.
It's not something that FASB said. It's something that New York State legislature put into place and said, this is a law.
Right. And the New York law has got one or two specific differences to UPMIFA, right?
Yeah, it does.
Remind me.
Yeah. So under New York State law, I think there's some additional wording regarding appropriateness of funds.
That's right.
You have to look at in terms of, what is the appropriate use and appropriateness. Both NMIFA and UPMIFA put spending guidelines. It's not prudent to spend more than 7%. So things like that.
Right. So if you're at a board meeting and portfolio happens to be down and there's a big need to be had, and everyone wants to spend 10% of the portfolio, you just can't do it. Just say no. Just say no.
Not prudent. The other thing again that we try to educate our boards about is just like on the investment side where that needs to be documented before a board can release the funds under the spending policy, even if it's written in the spending policy that we can release up to 4% a year or 5% a year or whatever the spending policy says or running average of the last 4 years.
Sure.
Or it doesn't matter. You still have to go through those steps that you were talking about in terms of the decision tree.
Okay.
And go through that and be able to say that we reviewed these points that are outlined in NMIFA. We did it for every single one of our endowments. And based upon the factors, we've made the decision to release or not to release the funds.
And put that in your minutes too.
Yeah. And so even though NMIFA and your spending policy allows you to, even though your spending policy allows you to do it, under NMIFA, it may not be appropriate.
That's right.
To do. So you still have to review that on a regular basis. That needs to be documented. And we're finding that boards aren't documenting these things because we read the minutes, we read we're just not seeing it anywhere.
Yeah, it's a shame because think of it this way, board members out there, NMIFA, bring it up at your next board meeting. Maybe you'll get some, stares and no one will know what it is, but, we definitely need to talk about it. And it's important to get out there.
Yeah. And so I get it out there again. NMIFA is the New York Prudent Management of Institutional Fund Act.
Right.
And it's
the law.
Just look it up. You can type in NMIFA and look it up and download a copy of it. And
Ken's an expert on it. He could certainly help in any way.
But again, I think really the point is that this stuff is just it's out there. It needs to be discussed at board meetings. The investment people that you're working with should be aware of this, so that when they're talking to you regarding your investments, and if you have endowments, they're talking to you about. And I know you do when you talk to your clients, you're talking to them about NMIFA.
And again, it's just not, it's not just one of these things where you could be insulated from it because you have a low cost portfolio at Vanguard. Doesn't cut it. I mean, yeah, it's good. Don't get me wrong. You should have, some Vanguard dollars passively managed, whatever, but you definitely need to have an investment policy statement and abiding by the rules of the road.
Okay, we have like a couple minutes left. Is there anything that you want to share or anything we didn't talk about that you'd like to get across to the people who are listening today?
Well, we covered a lot of ground for sure. I guess my takeaway is, with respect to to the board members that are out there and who sit on finance committees at organizations. I just think it's important for them to understand their responsibilities and their duties. This is serious stuff, folks, and I know that you feel good about doing it. You're not getting paid for it. It's volunteer. I get all that, but when you sign the dotted line as a board member, it's not just you're not insulated because you're not getting paid. You're still you are a fiduciary, and you got to act like one.
Yeah, and not to add salt to the wound here, but if you don't follow NITMIFA, which is a law, you could be putting the organization at risk,
right?
Because you have a D&O coverage and stuff like that, and most of those policies require you to follow law. And if you're not following law, you could void the contract.
Exactly right. And that's not good for anybody.
No, not at all.
Yeah.
So thank you, Peter. That was totally awesome.
Thank you, Ken. I appreciate it.
So for everybody who's watching, please tune in on March 12th when our guest will be Joe Campolo, managing partner of Campolo Middleton McCormick. Joe is going to be talking a little bit about the art of negotiation and how to negotiate effective contracts. So hope to see you next month. Take care, everyone.